You know, it was almost 5 years to the day, March 9th, 2009, that stocks bottomed after one of the most severe declines we've had in history. And as all of us who lived through that will attest, you know, the fear and panic reached levels that I've never witnessed in my career, and I know most of us don't want to go through a period of time like that again. But very, very severe decline in the stock market, very, very serious concerns really throughout the economy that our economic system would continue as it had in the past, and of course it did. And that's really what we're here to talk about tonight, is what happened in the aftermath, lessons we've learned, and how we feel we should position investment portfolios for the future. So we have tonight's presentation broken into 3 segments. The first is, have we recovered from the depths of the crisis? Second, how do we benefit from portfolio volatility? Because believe it or not, we believe that we do. And third, what are our expectations for the future? So have we recovered from the depths of the crisis? This first chart is a chart that shows economic growth all the way back to 1963. And you can see when the line goes up like this, we're having periods of very significant growth. And when the line goes below 0%, our economy is actually contracting. So during the financial crisis, our gross domestic product, which is a measure of national output, and this is in real terms after the effects of inflation are removed, we lost $639 billion of output. Since then, we've gained about $1.5 trillion in output, but as you can see, it's been a much more tepid recovery than what we realized in the past. And we think there are a number of reasons for that. One is that population growth in our country has slowed. And a sort of a fundamental factor of producing economic growth is an increase in population, because that's really what drives consumption throughout the economy. So with slower population growth, it is likely that we may experience lower economic growth as well. The second factor is that the depth of the decline was so severe, and the dysfunction in Washington, D.C. is so severe, that a lot of businesses have held off calling employees back who were laid off. They've also held off on making significant investment in productive capacity. So that uncertainty that has greatly afflicted economic growth in the opinion of many strategists. So we lost $639 billion, we've gained $1.5 trillion, but we should be much further along based on the pattern of prior recoveries from significant declines. Unemployment has dropped from 10% to 7%. Unfortunately, that masks a lot of people leaving the workforce. One of the reasons that unemployment is declining is the numbers of people leaving the workforce either because they're retiring or perhaps they don't have the skills to be employed in today's economy have been very significant over the last 5 years. There's another significant factor too, and that's while the private sector has been creating jobs, the public sector through state and local governments have actually been cutting jobs. And that's really one of the few times, maybe the only time in our lifetimes when there have been very significant cuts from the public sector. The good news is that a lot of that is probably behind us, and that effect in dogging employment might likely go away. And as economic growth continues, businesses will begin to get constrained by capacity, and we should see job growth continue in the private sector as well. You know, during the decline, we lost 8.8 million jobs. The recovery, we've only added 8.1 million. And again, there are a couple of reasons for that. One, what's happening in the public sector that I mentioned. The other is that all manufacturing has been creating jobs in this country. And the low cost of energy that's been produced by the big natural gas finds that we're sitting right in the middle of has produced a much more favorable environment for manufacturing. The problem, though, with the number of jobs created is manufacturing is so much more automated today that the number of jobs being created are far fewer, per output of supply. So that's a factor. So those things are going to take, a while to work through. But long term, both the fact that the public sector job loss is probably behind us, and that manufacturing jobs are being created will likely be good long-term developments, but will likely take a while more to play out. So even in a slow growth economy, stocks can generate really good returns. The returns from stocks are primarily related to two factors: what the underlying earnings are. So when you buy into the stock market, our investment strategies are broadly diversified. What you own is a share of the collective earnings of all the companies that are in your portfolio. So if you own a rental property and you're collecting rent, you have an asset that's generating an income stream. When you own a broadly diversified portfolio of common stocks, your income stream is the share of earnings that you're entitled to as a result of your ownership. The bottom right of this chart shows how earnings have increased on the S&P 500 index over the years. Very steady increases. You'll notice the very, very significant decline that we had in 2008, 2009. That decline, by the way, was one of the most severe declines in operating earnings that we've seen, really in modern history. But since the bottom, again, very steady increases in earnings. Now, if the stock market went up with corporate earnings, it would be much less volatile than what we experience. Because the other factor is, what are investors willing to pay in the aggregate for $1 of corporate earnings? And that's a number that changes to a large degree based on how good investors feel, whether they're feeling optimistic or pessimistic. And this chart on the left shows in the aggregate over time how investors have bid up or bid down the price of stocks. So I'll go back to early 2000, which was a high point. In 2000, we had just come off 5 years of the best return in the history of the S&P 500 index. And it was really the end of the technology stock craze, where everybody wanted to be invested in technology because the perception was developments in technology were really going to change the dynamics, really change the prospects for economic growth going forward. And as a result of that very optimistic attitude, investors bid up the price of $1 of earnings to almost $30. That's the price earnings multiple at the time, was about 30. So investors in the aggregate were willing to pay $30 for $1 of earnings. When stocks bottomed in March of 2009, the most that they were willing to pay was about 10. So you can see the drastic change in that 9-year period of time, where valuing $1 of earnings declined from $30 in 2000 to under 10 in 2009. And today, or at the end of the year, which hasn't really changed much, that number is about 15. And that's on the S&P 500 index. Since our strategies are globally diversified, price earnings multiples in other foreign developed economies and emerging economies are much lower. So on a broadly diversified global strategy, you're probably looking at price earnings multiples of in the 12 to 13 range. That is very reasonable when you look at how stocks have traditionally been valued. It's a bargain when you compare stocks to bonds because interest rates are so low. So when you're looking at the history of price earnings multiples, if we go back to the 80s, many of us might remember when interest rates were at the highest levels in the recorded history of our country. I think the prime rate hit about 21%, and mortgages were typically in the 15 to 18% range. And the reason that that's bad is that bonds are competition for stocks. So when interest rates are higher, people will bid down the price of stocks because there's more value in bonds. The flip side of that hasn't occurred, though, because in 2013, interest rates were at the lowest levels in the recorded history of our country. So in the span of about 30 years, we saw interest rates going from the highest level we've ever seen to the lowest level we've ever seen. But stock prices did not reflect the opposite effect of what we saw when interest rates were so high. So a number of strategists today believe that price earnings multiples will likely continue to increase because interest rates are so low. And there is a view that interest rates will likely remain low because governments throughout the world need interest rates to remain low to improve their balance sheets. The last time that governments throughout the world had debt levels as high as they do today was after World War II. And when you look at the history of interest rates remained low for almost 30 years, which allowed governments to reduce their debt levels down and really not be punitive to the economic growth. And so that could happen again. We could see interest rates remain low for a longer period of time than a lot of people expect. We're not counting on that. We're not making any bets on that, but it is, from reading the tea leaves and how things have functioned in the past, something that, could possibly occur. The other thing that drives price earnings multiple, and I mentioned this earlier, is whether people are feeling optimistic or pessimistic. And a measure of that is consumer sentiment. So there is some correlation between price earnings multiples and consumer sentiment. And you can see right here, the gray line is consumer sentiment, and the green line is the price earnings multiple. As consumer sentiment continues to improve, and it likely will if the economy continues to improve, we could again see increases in price earnings multiples. This chart shows the aggregate consumer, and it shows that in the aggregate, when you add all of us up, we're actually in very, very good position relative to our balance sheets. In the aggregate, we have about 91 trillion of assets to about 14 trillion of liabilities, which is a multiple of almost 7. So our assets exceed our liabilities, or the amounts we owe, and the principal part of the amounts we owe consists of mortgages on our homes, by a multiple of about 7. That's a pretty comfortable margin. One of the things that got us into trouble during the financial crisis was the amount of leverage that the investment banking industry had on its balance sheets. In March of 2008, Bear Stearns failed and was taken over by J.P. Morgan. In September, Lehman Brothers failed and was allowed to go into bankruptcy, which is really what initiated the terrible spin of events that we got. Merrill Lynch would have failed had it not struck a deal with Bank of America. And in order to prevent Goldman Sachs and Morgan Stanley, the two remaining investment banks, from failing, the government required them to become bank holding companies. But at the depths of the crisis, or prior to the crisis, the balance sheets of those institutions were levered by 40 times. So they had 40 times their capital borrowed to make investments. And if you do the math on that, that means a small 2.5% decline in the value of their assets made them insolvent. And that's really what caused the financial crisis. It was the excessive leverage in the investment banking community. So there are two things that have preceded big declines in the stock market. Excessive leverage. We saw that in 1929. We saw it again in 2008 and 2009. and when investors bid the price of stocks up to very high levels. We saw that in 1929 along with the leverage. We saw it in 1973, 74. We saw it in 2000. And we didn't see that in 2008, 2009. That was missing because stocks were really at reasonable prices. You can see that debt levels have been worked off in a big way too. So today, household debt represents about 10% of personal income, whereas prior to the decline, it was almost 40% higher than that, at almost 14%. And that's a pretty significant piece of your personal income. 4% for most people is a pretty significant number. This also shows that debt service today is as low as it's been in about the last 35 years. And then finally, we have household net worth. So this is the difference between assets and liabilities. And again, it's our collective net worth. And you can see that we're now at peak values again. We peaked in the third quarter of 2007, declined, and have come back. And the reason that we've come back is because of the stock market now hitting record values, but also because housing prices have recovered, in most areas of the country. There's a statistic that measures housing prices, and it's called the S&P Schiller United States National Home Price Index. It's still about 20% below the peak that it hit in 2006, measuring the broad national market. But there was a huge increase in housing values in 2004 to 2006, and then a very, very significant decline. And now we're back to about values that existed in 2004. And again, this is throughout the country. And there seemed to be some momentum behind housing prices because we really have underproduced new homes for a long period of time. So it's likely that there's a lot of pent-up demand for housing in the economy today. All real estate is local, though, as the old saying goes. So, there are areas throughout the country that are better than others, and but for the most part, that's the trend. And then finally, global stock markets have increased significantly since the decline. One of the most severe losses in the history of the stock market occurred beginning in late 2007 and extending through early 2009. The S&P 500 index was down 51% during that 18-month period of time. The worst annual return would have been 2008, where the DFA Global Equities portfolio, which is actually one fund, but it's very consistent with our overall global diversification, was down 39%, and then you can see what happened over the next 5 years. 2011 is showing a negative return, but the S&P actually eked out a slight positive return that year. The negative return was caused by foreign stock markets because that's when the big debt issues in Europe were beginning to surface, and there was an understanding that that might affect economic growth throughout the world. But the average return over these 5 years has been 18% per year. And if you started at the beginning of 2008 and invested at the worst possible time in that 6-year cycle, and you saw your wealth decline by 39% and then increase by 18, by the percentages there, you would have ended up at the end of 2013 with 1.4 times the amount you started. So the tendency of investors is to sell after this happens and not be invested to allow the gains to happen. And that's what causes permanent loss of capital. And that's why we work so hard to convince everybody that the strategy would work, just stay the course and allow your investments to recover. Okay, so how do we benefit from volatility? Volatility is a risk that can be managed. So when you're broadly diversified, you're not going to lose money because a single company is going bankrupt, or because an industry is becoming extinct, or even because an individual country is having trouble. You're going to be broadly diversified, over the global economy. So your risk from volatility is just the ups and downs in the market. And what's extremely important is to understand how to benefit from that over time. This chart shows the result of a continuing study that's being done by a firm by the name of Dalbar Incorporated. For about the last 30 years, Dalbar has been studying the ins and outs for mutual funds, when people are investing cash and when they're withdrawing cash. And they're forming conclusions on how that's affecting individual investor returns. The study is updated every year, and the most recent results we have is for the 20-year period ended 2012. And what their study shows is that the average investor has generated a return of 2.3%. Look at the returns that would have been generated from just simple buy and hold strategies in these assets. Real estate investment trusts, 11% per year. Right now, we don't like the valuations of real estate investment trusts, so even though you see the high returns there, we think the valuations are almost to the extreme that technology stocks were in the late 90s. So, you know, we're not making real estate investment trusts a part of our investment strategies currently. We don't like gold because there's really no way to determine what gold should be worth. It's all really emotional and it's speculative. So since we can't value it, you know, we don't like including it in an investment portfolio. But the S&P 500 index generated an average annual return of 8.2% over that time period. And that's after two of the biggest declines in its history. 2000 through 2002, it was down about 48%. And also in 2008 and 2009, it was down about 52%. And you can see even bonds generated a very, very strong 6.3%. So why does the average investor fare so poorly? And it's the reason is that aggregate behavior among investors is almost the opposite of what it should be. Individual investors tend to want to sell after prices have gone down, and they tend to want to buy after prices have gone up. And that's the exact opposite of what you need to do to create wealth over time. It's not necessarily buy low and sell high. It's to buy and sell at a higher price. And that's really what the game is for most people, because it's impossible to time buying, you know, at a low point. So typically what we do is we buy when we have capital available. We want to sell at higher prices. And part of selling at higher prices is being able to hold when prices temporarily go down. This is a measure of volatility, and this shows without a doubt the extreme fear and panic that existed in 2008, 2009. It was even at higher levels than what existed during the Great Depression years of the 30s. So yeah, we lived through some pretty scary times. And when you look at the other periods of really bad volatility, we have the Great Depression years, we have the late 30s, or the years preceding World War II. We have 73 and 74 when we were mired in Watergate. President Nixon had taken us off the gold standard in 1970, and it created a lot of dislocation throughout the economic system. It was, you know, the Vietnam War was ending, the OPEC oil embargo, prices were increasing at very high rates, and, you know, there was a lot of angst in the economy. 1987. This was less than a year after I had started JFS, and I was sitting in my Sam Spade office in a building in Sharon that no longer exists, as Sally called. And in one day, you know, stocks lost, you know, a significant amount of value, you know, 25%. I mean, that was a very, very scary time. But after that, you know, they recovered very quickly, so that the year 1987, had you been invested on January 1st, and just rode up and came down, you would have been up about 6% by the end of the year. So, you know, another time period where, you know, fear set in, but the best result was to hold firm. And then we had really the 2000 through 2002 period, lots of things happening. The potential scare of the Y2K event, the 9/11 event, the accounting scandals that occurred with Enron, WorldCom, and so forth. And then things calmed down, and then of course we had 2008, 2009. But when you look at, you know, most of history, a lot lower levels of volatility. So the message from this is when volatility occurs, it's too late to do anything about it. The time to do something about it is when things are tame, and the best thing that you can do about it is to make sure that your investment strategy is consistent for your needs, circumstances, and goals. Now, I'm not going to point anybody out in this room, but there are a number of you that we've had conversations with recently about reducing your stock exposure and increasing your bond exposure, and the reaction is, what? You know, you want me to move out of something that's been earning 18% a year and move into something that's been earning 2% a year. Well, the benefit of that, again, it's selling high and buying low, because interest rates will begin to go up at some point. But you really want bonds in your portfolio to dampen your volatility and to be there as a sort of stable value pool of assets to meet your spending needs and also to meet any unexpected needs. So please, when your JFS advisor tells you that it's time to take away from these great returning stocks and add to some of these poor returning bonds, recognize that there's method to our madness, and we really have your best intentions in mind. This chart, basically, I don't want to spend a lot of time on this, but this shows the complete cycles. We actually put this together in early 2008 to show people what's happened after periods of significant decline. So 1973-74, Karen Emmett and I were students at Westminster College back then, and I think I realized this sitting in an investment class, but the S&P lost 43% in 2 years. In the next 5 years, the annualized return was 26%. Now, inflation was much higher back then, so some of that return was inflationary, not necessarily just what was happening with corporate earnings, but very strong return. The next big decline occurred in 2000 through 2002. We lost 45% on the S&P, and then you can see the subsequent 5-year returns were nearly 17%. And then, of course, we saw what happened in 2008, 2009, and a subsequent 5-year return of 18%. So what's happened has been very consistent with what happened in the past. And even though history doesn't repeat itself exactly, it rhymes, as the saying goes. And it really comes down to prices dropping to the point where investors recognize they're a bargain again, and capital begins to flow back into the asset class, and we get back to more normal pricing, and that's a very consistent pattern. And then there's also relationships due to risk. So cash and bonds are less risky than stocks, so they return less over time. So when you have a risk asset, which is one that moves up and down in price a lot, you want to get a higher return from it over time. So the best protection against volatility is a strategic asset allocation that makes sense for your needs, circumstances, and goals. So what I did here was I'm showing you different allocations beginning with 100% in bonds to 100% in stocks. The long-term returns from 1979 to 2013, and this is based on our current investment strategy, and these returns are simulated as though what would have happened had you been invested for that long of a time period. But stocks generated about a 13% return from 1979 to 2013, and broadly diversified, including U.S. large, small, developed markets, emerging markets, and so forth. That's pretty consistent with a much longer period of history as well. And then you can see what happened in the 5 years through 2009 to 2013. We had much higher returns from stocks, but there wasn't a big decline in there. You can see what's happened to bonds, that a longer time period, including the very high interest rates that we had in the early 80s, would have produced a 7.1% average return from bonds, but over the last 5 years, only 2.1%, reflecting the very low interest rates that have been prevalent throughout our economy. And risk will increase along with these asset mixes. So the least risky, 100% bonds. The most risky from the standpoint of volatility, 100% stocks. And the way to reduce your volatility is to increase your bond exposure. And although you can see that you do decrease your return, The flip side of that is you're getting some stability in a portion of your portfolio so that you never have to sell stocks when prices are temporarily down. And that's one of the biggest reasons to consider cash and bonds in a portfolio. So due to the powerful tendency in the financial markets of returns to converge to the mean, this green line shows you the volatility of stocks over a one-year period. Worst year, negative 37%. Best year, plus 51%. A lot of volatility in annual returns. As you go out to longer time periods, you can see over a 5-year period of time, the worst average annual return has been negative 2. The best has been an average of 28% per year. 10 years, negative 1 to 19. And when you go out to 20 years, there are no negative 20-year time periods, at least in this time period of 1950 to 2013. I believe that when you extend that to a longer period of history, there's one negative 20-year time period. When you go out to 30 years, there are none. Now, a lot of us, are beginning to wonder, does it make sense for us to think in 20-year increments? And the way we have to think as your advisor is that really you never run out of money, that you live forever, because we don't know, when we're all going to die. And I think it's fortunate that we don't. But once you begin to consume principal, your capital just rapidly declines. So the way we want to plan for you is that you live forever and your money lasts forever, because we want to be very certain that that your money doesn't die before you do, saying it that brutally. So we plan for you to apply a spending policy to your amounts, and then we model that through the historical range of volatility to make sure that how much you're drawing on your financial assets is sustainable, and sustainable through some of these very difficult periods of time. So the longer time period you have, there's a benefit to that. But even as short a period of 5 years, there's more predictable returns from stocks than on a one-year basis. Okay, so what are our expectations for the future? First is, there are other risks besides volatility risks that we as your advisors need to be concerned about, and that you as individual investors need to be concerned about. And one of the most significant is inflation. Inflation is increasing costs, and if you're retiring and you have a 30-year retirement period, you need to plan that costs 20, 25, and 30 years from now will be substantially higher than they are today. The other is longevity risk. With great advances in healthcare and healthcare professionals developing ways to take better care of us, it's highly likely that we're going to have longer lifetimes than our ancestors did. And as that longevity occurs, we need to make sure that, again, that our money can last longer than we do if we're going to realize all of our financial objectives. And then finally, and there's no right or wrong answer to this, many of you want to leave some to your heirs. And if that's the case, then our modeling needs to take that into consideration as well. So inflation over the last 50 years has averaged about 4% per year. For currently, it's about 1.7%. The stated objective of the Federal Reserve is about a 2% inflation rate. Our culture is to have some inflation, primarily because deflation is so bad. Japan has experienced deflation over the last 20 to 25 years. And in a deflationary environment, everybody expects prices to decline, so nobody buys anything. And it really, really puts the brakes on economic growth and activity. So the better way to plan is to plan for price increases. That actually, if you expect prices to go up, then the incentives are different, obviously. So in our modeling, we use 3% for inflation. 3% is the average over the last 90 years. Our government policy is 2%, so it's maybe a more conservative way of planning, in that we're expecting a 3% increase in future costs rather than the 2% that's the stated policy, thinking that we will see periods of higher inflation in the future. And you can also see that inflation has varied over time. And right now we're back to levels that we last saw in the 60s. But in the late 70s and 80s, we had very, very significant inflation in this country. And then, we've had very significant declines since then. A short period of time where we actually did have some deflation in the economy. And really everything that the Federal Reserve has tried to do has been to create inflation and prevent us from going into a deflationary time period. The effects of inflation, what costs $50,000 today at a 3% average inflation rate will cost over about $105,000 in 25 years. So it's more a doubling. So again, when you're looking at a 25 to 30 year time period, if you need $1 million to generate $50,000 today, you're going to need $2 million in 25 years to generate $100,000. And that means that as your advisor, we have to help you grow your capital so that you can generate those greater amount of incomes in the future. The way we manage longevity and bequest risks is through this financial modeling that we do. And I would probably venture a guess and say that most of you have probably seen this. It's a Monte Carlo simulation. And what that means is that we're looking at the historical returns and volatility, the ups and downs from various investment asset classes, and saying that if returns are random, let's do thousands of calculations showing a random return each year and work that out, over your life expectancy, which we work to a 30% probability. So most statistical life expectancies are a 50% probability. We're working to the 30% probability, which for most of you, would be a life expectancy into the early to mid 90s. And we're averaging all those random calculations together to come up with the percentage of calculations that show you still have money left at age 93 or age 95. And we want to do that every year as your circumstances change and as your asset levels are changing, to make sure that we're giving you the right guidance on overall asset allocation. Are you taking the right amount of risk, not too much, not too little, to generate the types of returns you need to meet your financial objectives? So our 5-year expectations. This is the same chart that you saw before, and this is really based on how bonds and stocks are priced in the current marketplace. Over the next 5 years, we think interest rates are signaling about a 2.5% annual return from a broadly diversified portfolio of bonds. The way stocks are priced today, we think high single-digit to low double-digit returns are likely. Could be much better because we're assuming that price-earnings multiples remain about where they are. If the prior relationship holds, that increasing consumer confidence increases price-earnings multiples, we could see better returns. On the other hand, because we don't know what the news is going to bring, negative events could cause us to turn pessimistic, and we could see lower returns than that. So I would say that there's probably, and there's no way to statistically determine this, but just, sort of dealing, with judgment, I would say that there's about a 50% probability that we would do better or worse than the 9% return. So that's, but that's over a 5-year period of time. Over a much longer time period, I think we can safely say the way stocks are priced today, we should see high single-digit, low double-digit returns. We think likely over the next 5 years, but much more likely over, the next 15 to 20-year period of time. So the key principles then, let's determine a strategic asset allocation or investment policy that's appropriate for your needs, circumstances, and goals. Let's understand the risks that you are accepting. So when you see an investment policy from us, you also see the worst returns that policy has generated and the best returns. And it's up to us jointly to gauge, whether or not that's appropriate for you based on your risk tolerance and your financial objectives. The less volatility risk you're willing to accept, the lower your returns are going to be. But if you have enough assets and you can accept lower risk, the trade-off then is I'm willing to accept a lower return for a greater peace of mind and not dealing with the ups and downs in the financial markets. Third, you need to change your strategic asset allocation, with our guidance and advice as your needs, circumstances, and goals determine. So when you do have a major life event, we need to get together, we need to analyze the effects of that, how your goals and needs are changing, and make whatever modifications seem appropriate. Let your strategic asset allocation then manage the volatility risk. So stocks going down, unfortunately, it's kind of a necessary ingredient to getting the better long-term returns. So unless something is really changing in the fundamental way that businesses do business and to generate profits and returns to shareholders, it's best to stay the course if you're comfortable that you have enough in stable value investments to not have to sell stocks when prices are temporarily down. And third is to be aware of investor behavior that there's overwhelming proof of that causes us to sell after prices have gone down and want to buy as prices go up. So we were talking about Fox News earlier, and I can tell you 5 years ago, I could almost tell a person walking down the street who spent too much time watching Fox News because there was nothing, nothing happy about it. But and I'm just using Fox News, generally. I happen to like it, but you don't want to pay too much attention to these events that are likely to be temporary, because if you overreact to them, at least what's we've seen proof of is that by overreacting, it's going to result in a permanent loss of capital. So if you sell when prices go down and you're not invested as prices go back up again, that's what results in the permanent loss of capital when you're very broadly diversified. So that's how you want to control volatility risk. When you think about inflation, when you think about longevity, when you think about bequests that you want to leave to your heirs or charities or others, you need to be thinking about the higher returns that come from common stocks, because that's what's going to cause you to, that's what's going to cause you to show greater growth of capital over time. And I get really distressed when I meet people who are so disenfranchised with the stock market that they don't even want to consider it, because it today is the single best tool that all of us have to build wealth if we don't have the privilege of owning a business or directly owning real estate or something like that, where you can earn above average returns. Investing in common stocks today is the best wealth building tool that that all of us have as individuals. Again, save that owning your own business and direct ownership in real estate and a few other things. So in closing, then, I want to bring us back to the long time period of history where we can see the benefits of investing in these more risky asset classes. So you see the volatility, the ups and downs. You see the benefit of time, how things go up. You see the lower volatility in bonds and cash as measured by T-bills, but you also see the significant amount of wealth that you can create by bearing that volatility risk. So how do you benefit from volatility? It's by participating in the financial markets over time and not reacting to the short-term negative news that that happens frequently. Okay, so I did talk longer than I wanted to, and that's because I wasn't paying attention to my script. My script was 20 minutes, and I knew I would do that, so, so thanks. Thank you.